that I can think of. Right now, the stocks are going up and down. Getting into the market is good, but it's always a risk. But with a house, no matter if the values go down or up, you will always have a home that's yours. Is that me? Um, are you recording me? Okay, great, great. I sound great. So there's tax write-offs still even though with the new tax program, it's still good. We still have some reimbursements when we do tax returns. It's the best long-term investment, and I always like to put down the scale of how the investment really grows when you have a home. And then stable housing costs. So once you get into your home, you're going to get a fixed interest rate on your mortgage, and you'll always know it's going to be the same cost, as opposed to renting. A lot of landlords can raise your rent every year, every 2 years at a certain percentage. But with housing costs, it's always the same. And it creates wealth because if you live in your house for at least 5 years, or as Jennifer can share with us, after 2 years, she was able to sell the house, have a profit that paid for her second house, right, Jennifer? So
Yes, so
it's
I
really
always like to
great.
tell this story. First, I always like to, am I muted? No, I'm good. Okay. With Isabel's idea, I mean, when she says taking this class, I wish I would have before I purchased my first home because I didn't have the greatest experience. But I did buy something tiny and we were like in a shoebox. But 2.5 years later, I made about 120,000 on it and was able to put 20% down on a property here in Whittier, which is where I wanted to live. I had to buy in a different city and then move over here. So yes, it creates wealth so quickly.
Great. And then you leave a legacy for your children, which is one of the ways that so many people can increase their wealth. And property always increases in equity or in value. And again, it's the best for the hard work you're going to do to pay this house. It's the best investment. So I'm pretty excited about the home buyer education. But it comes with a little work. Now, as a renter, if something breaks down, you call the landlord and wait for the repairman to come over. So here you become your own, landlord. You call yourself to fix something, and there's simple things that you can learn at those classes from Home Depot. So you just have to think about repairs and maintenance. I know with my mom's house, I always helped her every 5 years to paint the inside of the house, and then she would hire a handyman to paint the outside. So it's not like that hard. It's just trying to find a good handyman. And then having a house keeps you from moving from apartment to apartment, so it creates stability. There's some additional cost to having a home other than the repairs. And the possibility of your equity decreasing is always there. But I still think, even though in the recession, I remember my mom's house that she bought in 1988 for 90,000. During the recession, it was up to 300,000, and it decreased. But within 6-7 years, it went back up, and now it's worth 450,000. So imagine that. She could even, take out a loan and get rental property. But it's just, I think just having a house is really great, even though it just goes down with the market. And then if you don't make mortgage payments, you do risk the foreclosure process. But that's where I come in and help you try to figure something out. Okay? So great. Any questions? rent versus owning. So I used to say, you're going to have a payment shock when you buy a home, but I understand the payment shock is because you paid so much rent. Some people pay more rent than some house payments, so that's a shock to me. And so what we do is we help you figure out your cost of living, and based on your income, do you have to change anything in your style of living to sacrifice and save a little more to make the mortgage payment? But that's always workable because you have this strong goal of buying a house. So, are you ready? Do you have a steady source of income? Have you been employed more than 2 years? Is your income reliable? Imagine if you were a famous actor and with this COVID, now everything stopped, but you're a teacher, so you're always needed. Do you have credit history? Do you have good record of paying bills? Do you have money saved for the down payment? So if you answered yes to all these questions, you're ready to buy a house, right? Right? Okay. Okay. So needs versus wants, urgency to move. So we're assessing your situation, confidence in your income, how much have you saved, your credit rating. Okay. So you need to create a plan. By when can you move? By when can you buy? What's the next step? So let me see if I can get to the checklist. So I want to get to here. I want you to understand that you're not alone in this goal of purchasing your home. What you're going to do is encounter people who will help you with the purchase. And I always say, this is your team. I am on your team. I am your HUD counselor that will help you. Are you okay, Joe?
No, I just lost one of the note cards I was writing down on.
Oh,
So I was trying to
darn.
look for it to write. So I'll find it. It's small.
Okay. It
I'll
just
get it.
looked like there was a
I'll
lot
get
of
another one.
movement. I was
Yeah,
going to
no, I
say,
was
is
trying to
he
look for
that
the
quick?
card. I just put it down. I'll find it again.
Okay.
I'll create a new one.
Anyway, so you're going to encounter folks that will help you with the home buying process. And I want to have you consider what you're going to do is create your team to help you reach this goal. So part of your team is your HUD counselor, which is me. And we offer all those counseling services at no cost. We're introducing you to a realtor who will be the one who finds you the house. I have your lender here, Jennifer, and then there's going to be an inspector who looks at your home to make sure that the house that you like is in good condition. We talk about insurance agents who will write the insurance, the property insurance, to help you protect your property and asset. And next week, Daniel will talk about once you get the offer approved, we open up escrow, and he will explain what escrow is all about, what happens, and the purchase agreement. And the other team members are the appraiser, who will put a value on the house that you're looking at. And am I missing somebody? That's about it. So I know. So do you have any friends, Joe, with trucks?
Well, I'm the one with the truck. So
Oh, okay.
I do moving and hauling on the weekends for cash, and then I also
Wow.
so I do cabinets and stuff like that.
Look at you. Okay. We need
Ooh.
to call on
So
you.
you can see potential when you see your house, when you see the house that you want.
Yeah, not just that. I know what the costs are. I know what the longevity is. I'm Cal 99, but I've stayed most of my life in education, social services, and stuff like that. But um, through need, it's you picked up stuff on the weekends for cash.
Good,
Oh,
good.
that's
Well,
awesome.
usually I say part of your team should be friends with trucks to help you move to your house.
Uh-huh.
And then all these team members you can invite to your housewarming party so we could bring you some food and curtains because you'll be out of money.
I think Joe's now going to be on my team, Isabel.
Yeah,
Write
yeah.
his name and number down.
We're going to have to
One of our
hire him.
team.
Yeah, absolutely. Okay, okay, great. Um, so, financially, are you ready to purchase a home? So, what we do is we go over your budget and income. And what I want to do is turn this over to the lender because what we've done is assess your the point in your life that you're ready to buy a house. You've been working, sounds like 2 jobs, so you've been saving money. Your credit is good, and so you're ready now to talk to the lender. Okay. So, Jennifer, questions, comments? Okay.
Yes. No, I'm ready. I'm ready.
All right. So
So,
we're talking about credit report.
okay.
So let me get to the lender. All right. Here we go.
Okay. So, I love lending, Joe. Let me just tell you a little bit more about myself. I've been in banking for the last 15 years, and I've specialized in mortgage the last 7. I love what I do. This is owning a home is the best thing that you can do for yourself and your family. So, I'm going to start with I'm just going to follow the slides as we go. Do you know the mortgage products? So you have your fixed rate products. That's the most common, most common one used. So you hear 30-year, 15-year. There are other lengths of time that you can do. A lender can do anywhere between 10 and 30 years. It just depends on what you want and what your comfort zone is. But that's the most common one, the fixed rate product. You also have your adjustable rate mortgage. An adjustable rate mortgage is, let's just say it's fixed for a certain amount of time. So the first 3 years, 5 years, 7, 10, and then it adjusts every year after that. You have your balloon reset mortgage. You really don't see those quite often, but a balloon payment would be just a big payment at the end of your term. Graduated payment mortgage, you have your interest only mortgages, and then your ARMs, which is the same as the adjustable rate. So, yeah.
Okay.
Budgeting benefits and tips, increasing your income and reducing your expenses. A budget is an important tool to help you understand how and where you spend your money, and guidelines to help you spend your money on the things that are most important to you. So have tips and suggestions for you to budget and just have a little bit more to help towards your down payment and your closing costs. You definitely, if your employer allows it, you can have your employer deduct money from your paycheck and deposit in your savings account. Put unexpected income into your savings, and if you use your savings for an emergency, treat it like a loan. Make sure you pay yourself back first, and prioritize which debt to pay off first.
Great.
Any questions, Joe, on that one? On the budgeting? So the topics I'm going to cover is what is a mortgage, what are the steps involved in obtaining a mortgage loan, getting approved for a loan, how much is a lender willing to lend, how to know if you're ready to buy, calculating qualifications, and how do you increase your borrowing power. So this is the process, and it's about a 30-day process. This is what we're going to go through in the entire. So usually your escrow time is going to be 30 to 45 days. If we're going to be using a down payment assistance program like the HOP program, the WISH program, I always request for us to use anywhere from 40 to 45 days because it takes a little bit longer for them to give us approvals. I'm going to be your best friend or your lender is going to be your best friend. I'm going to request things that you are going to kill me for or feel like you've given to me. And we go back and, I submit everything to processing. I always have a complete file. I make sure that we have everything needed. But this then the loan then goes to processing, and the process is like, oh, I need A, B, and C. And then that loan goes to underwriting, and underwriting is like, oh, thank you for A, B, and C, but I also need, D, E, F. So it gets a bit tedious sometimes. With standard income like yours, where it's an educator income, it might be a little bit easier, but just know it's going to feel like you're giving me blood samples and everything else. And I apologize, but it's worth it at the end. So this is so you're going to go through your pre-approval, the loan application. The loan application is something that you'll receive once you find your property, right? So that's when we actually start the loan application. One thing that I always like to explain: when I get you your pre-approval letter, it's going to have a certain amount and a certain interest rate. That interest rate is not your interest rate for this home, because there's no lender out there that can lock a rate in without you actually having a home, right? So we will have to be in contract in order for us to lock the rate in. So I gave a client a letter 2 months ago, and the letter said 4.625. And with today's rates, we were actually able to lock him in now that he found a home at 3.875. So it makes a really big difference.
Yeah.
Mm-hmm. So after the loan application, we'll go through loan processing, underwriting, approval, and closing. You're going to see that it's probably we're going to go forward. It's like chutes and ladders, right? Chutes and ladders. So we're going to go forward, and then the others are like, I don't like it. Let's go back. And we're going to go back to processing and back to underwriting. So sometimes it's beautiful like this, but sometimes it's chutes and ladders. It goes back up.
Okay, next, right?
Yes, please.
Okay.
What's the difference? So pre-qualification. A pre-qual is really only a projection, right? So no credit report is pulled. Limited information is required. You don't really get pre-quals anymore from lenders because we're pretty much shooting ourselves in the foot. If I give you a pre-qualification letter, you take that to Daniel, and I'm only going based off of the information you gave me without actually pulling credit or looking at pay stubs. I can say you're pre-approved for 580. Then you get a purchase contract, you get yourself approved, and you done? Sorry, my son's a little loud in the background. I apologize. Then you get to Daniel, and you come back and we pull credit, and you're only approved for 480. So we definitely, most lenders don't do pre-qualifications anymore, but yeah.
Okay. All right.
Pre-approval is what we do. So this is firm. We pull credit. We look at your income. We look at your assets to make sure that you have your down payment. And then we give you your pre-approval letter. So this is what you will receive most of the time from most lenders. Again, I don't see many that do pre-quals anymore. Once you receive your pre-approval letter, this is good for 3 months. So your pre-approval letter, you can shop and go for 3 months. What I do for my clients, Joe, and I know a lot of my colleagues that are in the same industry do. Let's say you're pre-approved for $600,000, right? But Daniel finds you a home that's $525,000. We don't want to show the letter showing $600,000. That way, they know that what your highest is. So most of my clients will come back and say, Jen, get me a letter that says 525. We know our max is 6, but let's redo that letter. And that's something that's easily done, and I can print it and send it over to you. Okay. So the 4 C's: credit, capacity, capital, and collateral. So credit, do you pay your bills on time? Do you have any collections or public records? Let me, I'm going to use the same scenario for the gentleman that just put an offer in. His credit was a bit lower. We were under the 680. And his MI, because we weren't putting a full 20% down, his MI was about 500. It was a larger purchase price. It was about $500, $525 if I remember correctly. He worked on his credit and got it up to over 680, and that MI went down to 410. We were saving him. I was able to get him a little more house because he got his credit up. So it's very important. Everything, your interest rate, your MI, if you're going to have mortgage insurance, everything is based off of your credit. So the higher the credit, the better the credit, the better rates we're going to get all around. So when we look at credit, current debt is the next one on this slide. And you definitely want to look at your installment accounts, your revolving accounts, and other monthly payments. What we're going to take into consideration, Joe, is going to be your monthly payment. So you could have a line of credit that's $60,000. We just want to know what that minimum payment is, right? Because the less in the payments that you have monthly, the more you qualify for a monthly mortgage payment.
What are installment accounts?
Anything that has a fixed rate. So like a loan, like a car loan, it's a specific amount. It's not a revolving. So a revolving would be credit. Anything that you pay back and you could reuse, that's a revolving account. So like a personal line of credit, a credit card. An installment loan is like, let's just say you do a debt consolidation loan. That's a full principal and interest payment.
What about student loans?
Yeah, a lot of my educators. Student loans, we take into consideration if you're already paying back, and let's say there's a minimum credit, a minimum payment on your credit report, Joe. That's what we're going to take into consideration, that minimum payment. There are some student loans that still don't. Let's say they're deferred for 10 years and there's a zero payment. We have to take into consideration at least 1% of that as your monthly mortgage payment. Monthly student loan payment.
Yeah, that's how mine are. So mine are deferred 0. So my monthly payment is 0. Next year, there's since I've been working with school districts and nonprofits for the last 10 years, it gets forgiven completely. So
congratulations.
I'm next September or next October away, turning in the paperwork, filing with HR, and it's forgiven. And it's a 2-month turnaround. So should I wait until then?
No, I would say let's look at you should look at the numbers and see where you're at. And just so you know, okay, so let's say you have $60,000, right? So we're going to take 1% of that as your, I'm just, throwing a number out there. 1% of that as your monthly mortgage payment. As your monthly student loan payment. So, no. I always say get yourself looked at and know where you're at. And then you can put a plan together, right? Then you can say, maybe it is worth me waiting and not having those student loan payments. Because remember, we're only going to take the minimum payment.
Okay.
So capacity, your current income, income history, and future earning potential and amounts you owe.
Okay.
Capital, the amount of down payment, your loan fees, closing costs, escrow impounds, reserves, and moving expenses. Your collateral is the value of your home worth, what you're paying for it. Sorry, I think it's closed off. I can't see that end, but yeah. And then the condition of the home is going to be the collateral. So the collateral is pretty much the home that you're buying. Any questions on this? Determining your qualification, credit scores. It's so important. I just focus on it. It's just the most important thing is your credit score. Your loan to value, your income, your debt ratios, and employment history. That's what we're going to look at when we're trying to qualify you.
Great. Okay. All right. So
debt to income ratio. I'm a nerd, so I love all these numbers and percentages. I do it all the time. So your debt to income ratio is what the amount that you can buy, right? So right now, your DTI can go up to 50%. I'm usually pretty conservative and I'll do anywhere maybe from 45 to 47. Just so we can have a little bit of room left in case of something that comes up later. Like, let's just say you want to purchase something in a condo that's going to have additional costs monthly. So I always use about 45%. So we're a bit conservative. But if needed, let's just say you do find a house that's a little higher, I'll go in and we can go up to the 50% and make sure that that's something that we can approve you for. But so your DTI is your total income. So let's say you're making $100,000 a year. The way you want to do this, Joe. So 100 and you want to divide that by 12. So that gives you about 8,300, and you want to times that times 45%. So that's going to give me 3,750 of what you can use monthly. So that's your debt to income ratio. That's all of your minimum payments plus your new mortgage payment, principal, interest, taxes, insurance, and if you have mortgage insurance, your MI. Okay.
So that's 3,750.
Yes, that's on $100,000 income at 45%, Isabel.
45%. So how much of a house can you buy with that?
Oh, this is going to get you a good amount. If you have no other debt, this is going to get you probably 650, 700, depending on how much we're putting down. If we're putting down a good 5% and your credit score is over 720 and I could get you a low MI, Daniel, and my calculations pretty good. That's okay. Mm-hmm.
But the county only gives it's a max of 495.
What do you mean?
Yeah, so the amount, the HOP is a maximum of 495. So it has to be under that amount.
I think in LA County, and I was actually looking over the HOP documentation, I think you can go a little higher on the higher assessed areas, but I can definitely do a little more research on that. But yes, if you're doing 495 and they're giving us I think it's 60 that they give. And I apologize, I don't have the HOP paperwork in front of me.
They give up to 75.
Okay. So yeah, I mean, you'd be looking at a mortgage payment that's probably about 2,100 because you're not going to have mortgage insurance if it's 495 and they're giving that, and you have to put your own a certain percentage. And we can get you Wish, and we can get you the grant. You're looking at a nice down payment. So housing ratios and debt to income ratio, I kind of just wanted to give you what we would be looking at with $100,000 income. Your front end ratios are considers mortgage versus income, right? So your front end, when they talk about front end, they're just taking your mortgage payment, your new mortgage payment with principal, interest, taxes, insurance, and MI. Your back end ratios, including all of your debts with that mortgage payment. So that's when you hear those terms, that's what they're talking about.
Okay.
Employment history and income history, we definitely look at the last 2 years. There's some, I've been working with a lot of educators lately. So I've had some that do like different programs throughout the year. We do need, in order to include the additional income, like let's just say I had one that does a Spanish class and she just started that last year. So that's an additional income that she receives. We do have to see two years of the additional income. It's sort of like overtime income. We do need to see a 2-year history. So we'll definitely take into consideration your base pay, and then anything else on top of that, we want to see 2 years. But it's the same as anywhere else. We want to make sure that you're in your field for at least the last 2 years. Most programs require proof of such income, pay stubs, and tax returns. And self-employed individuals, we definitely want to see that you've been self-employed for at least 2 years. So your loan to value is the value of your home compared to how much you're actually putting down. So your down payment or any of these programs that you're using, right? So here's an example of an appraised value of 110, and your purchase price is 100,000, right? And that happens sometimes where you put an offer in for, I don't know, 250,000, and then the appraised value comes in at 255. Perfect. You've already made a little bit of equity there. So here at the bottom, it'll show you if we do a loan amount of 80,000 on that purchase price of 100,000, you put in 20%. That's kind of what it's giving you the calculation there. Credit score. So minimum credit score required by lenders depend on the loan program. So the 580 you won't see anymore. Most are 620. Even especially now with the COVID-19, a lot of like your FHAs and things like that, you're looking at a lot of lenders requiring a 680 instead of the 620.
Wow.
And your maximum credit score is going to be in 850.
Oh, so because of the COVID, the score went up?
Yes. So what lenders are doing, there's always a Fannie Mae guideline, or if you're using the FHA product, the FHA product has their minimum guidelines, but banks and lenders can layer on top of that. And so most of them layered and increase their credit scores, some to 660, some to 680,
Wow.
and using some of these products.
Okay. More work for me. Okay, thanks. Okay, are you ready to buy a home?
So
Okay.
use these questions to help you determine if you're ready to buy a home. So did you want me to take this on, Isabel, or is this you? I can take it on. I love it.
Go ahead. Uh-huh.
So, do you have a steady income? Have you been employed for at least 2 to 3 years with on the regular basis? Is your income reliable? Do you have a credit history? Do you have a good record of paying bills? Are you able to pay bills and other debts? Do you have money saved for your down payment? This is number one. And if you've answered yes to all these questions, you might be ready to buy a home.
Yay, great. Okay,
So, how much can you afford? As a rule of thumb, many people estimate that they can afford a mortgage of two of 2.5 times their household income. Examples are below, so you can see that there. But don't worry about that. I'm going to take care of it. So you could disregard any lender that you're going to work with. We're going to take care of how much you can afford. And like Daniel says when he presents, even if you can afford a mortgage of $3,700, that might not be where you're comfortable, right? You might want to have a mortgage payment of $2,200 instead of that. So just because you can afford it doesn't mean you want.
okay, great. All right, so let me skip that
Okay.
since you're going to do that. All right, so you're going to provide a pre-approval letter once you go through all the calculations.
Yes.
Is there a charge for that?
No.
All right.
No.
Okay. So far, so good. So now that you know how much of a house you can buy, you need to find someone to help you find the house. So we have Daniel. I've known Daniel for more than 3 years.
I like it, Daniel.
And very successful broker. And I trust him very much. So I'd like to introduce you to Daniel Andrade and take it away. All right.
With Beautiful Homes Real Estate, and I'm a real estate agent. Let's see, we're going through the slides. I don't know, do I have a slide?
You know how the other slide has only 5 things to talk about, right?
Okay, no worries. Now we're talking about the home buying process, like how to buy a home. So that's what I'm going to go over.
Yes, shopping for a home.
Yes, shopping for a home. So the way that we normally go about looking for homes is, the most important thing that we start with is talking with the lender, because the lender is going to be the one that says, hey, they're the ones that are going to tell you kind of the price. So I know that Jennifer gets really mad at me because I get excited. I'll find you guys. I'll take you out looking for a home, right? So Joe, you'll get excited about a home. So Joe, kind of what area are you looking for again?
La Mirada, Whittier, Norwalk.
Okay.
LA County, Bell, Cudahy, Maywood, Bell Gardens.
And you're considering the HOP program.
Pico,
in the area. So we may start in Whittier. Let's say we'll start in Whittier, we're looking at the homes, and maybe the homes we're looking at don't make sense. So I know I actually have somebody looking for a home in Whittier. We were out looking, they were around 450, and the homes that we're looking at are in really bad condition. Like they look like they're falling down, they look a little sideways, they look a little crooked. So we had to consider expanding the area that we're looking at, right? So the way we'll do it is, one, I know that you normally have homes that you like, things that you're excited about. Maybe you saw something online that you'd be interested in. So we'll start by looking at those. So what a lot of clients will do is they'll just take a screenshot of whatever it is they're looking at. So maybe you're looking at a home that you found online. You say, hey, this home's really good. Can you find out more information about this one? So those are things that I'm able to go in and find out more details. So you may be really excited about a home. I'll find out more details on it, and when we go to the home, we'll find out, hey, maybe it just needs a little bit of paint. Maybe it just needs new flooring. Maybe the carpet's old, and that's all we have to do to the property. There's other instances where we'll go to the property and we'll find out, hey, you know what? It looks like the back of the house is falling down. Or like the home that I was saying that we went to go take a look at, the foundation was just destroyed. Like it looked like the house was splitting in half, and it's a flat foundation, right? It's a slab, so it looks like the slab is broken in two. So that would be something that we'd pass on. And then I'll go through and I'll send you over some of the homes that are available in the area. That way you can see what's available and we'll start looking at those. So the first time we go out, we'll maybe go look at 10 homes. Just to kind of, normally people will look at about 10 homes, but the first time we'll go out, we'll look at 3 or 4 homes. And this is in a normal market. We'll look at 3 or 4 homes the first time we go out. The problem is we're not in a normal market right now. So with the whole coronavirus thing, there's a lot of changes that happen in the real estate industry. And this is kind of interesting, and it's sad for us. But what happened recently is we have to fill out forms it's a COVID entry form. I know the initials. It's a PEAD. It's an entry authorization, right? So we have to actually get authorization from the sellers to show you the property. Aside from that, we have to you have to sign it and say, hey, if you get sick, like if you get the coronavirus while you're at this property, you won't hold the owner liable for getting coronavirus. And this is a brand new thing that just came out. It was 8 days ago that we started using this form. So every single property that I show you, I have to get you to sign that form, and we have to send the form to the seller. So now it's not as easy as saying, hey, I want to go look at 3 or 4 homes. Let's just go look at them this afternoon. I actually have to fill out the form, get you to sign the form. I sign the form. I send it to the seller. The seller signs the form and says, yes, I got it, for each property that we're going to show. So before, like I was saying, we would show 4 or 5 properties one day, and then the next weekend or maybe in the evening we'd go see a few more. What we're doing now, just in this market, is I will go out and look at some properties for you. I'll do video. We can do a one-on-one like this through Zoom. We can do it through Skype. We can do it through Messenger, FaceTime, whatever it is, and I can show you around the property while you're at home eating popcorn. Now, I know that usually buyers want to go out and look at the properties because, the best part about looking at properties is when you can see yourself in the property and you can envision yourself in the property and you start getting excited about the property. You kind of figure, okay, this is going to be what my yard is going to look like. This is what the living room is going to look like. I can visualize my couch on this side or that side. So that does take a little bit away from the properties, from the whole buying experience, but we still go out and look at properties. So we'll start by looking at a few homes just to get an idea of what's available, kind of what properties you like, and we have to see if these properties even make sense. Because obviously you don't want to go buy a property that needs a lot of work. And you don't want to go buy a property that's worse than the place you're living at now, right? So you always want something a little bit nicer, maybe something a little bit bigger, and then we may have to consider, okay, maybe this neighborhood doesn't work. We'll have to go look in another neighborhood. with the and then there's also the different programs that you would qualify for. So I know you'd mentioned the HOP program, so we'd have to actually go through the HOP program and figure out what some of the HOP requirements are. So, because every program has different requirements. So the HOP program may have some requirements. That one's an LA County program. Do you guys know?
Yes, that's LA County.
Okay, so that's going to be an
Yeah,
LA
so
County program.
yes, and only certain cities. So I'm looking at it now. It looks, I can send you the list, but yes, it's an LA County program.
So is it like the unincorporated?
Yeah,
I don't see
no,
any.
unincorporated is
No,
only
it's not.
like no. It would even consider for like the city of LA, but city of LA actually has its own, and they do up to like 90,000 at the same time.
Yes, they do the LIPA or the MIPA. Mm-hmm.
Yeah.
Yeah, so I've done.
It's like you're looking at Agora Hills, you're looking at Arcadia, Avalon, Azusa, Bell Gardens, all of the cities that he mentioned.
Okay.
I don't see though, Joe. I don't see Whittier on this list. Just FYI.
I think it's like South Whittier or something like that. I don't know.
Okay.
You'll say South
Okay,
Whittier.
okay.
Yeah.
So I'm kind of feeling like it's the unincorporated areas that it would be. So that would be something that we kind of look at and we go through the list and we'd say, okay, do these properties qualify? Do these properties make sense? Is this something that we can work with? Right? And then sometimes we can work with them, sometimes we can't. Sometimes we have to say, you know what, we're going to have to look in other areas or look at other programs. Or, for instance, we'd also mentioned, like you mentioned, the LIPA program. There's certain requirements on the property. Like one of the ones that always gets us is the city? Does the city need to go and do an inspection? So there's, even though it's a whole, even though the program sounds simple, there's a lot of requirements. So, for instance, the house may need to qualify. Right? So it wouldn't just be you need to qualify and you have to qualify for the program. The individual property may not qualify. So that's something that we have to keep in mind when we're out there, looking at these properties. But we'd go through that. Or if you were going to go FHA, we'd have to look at the FHA programs and see what it is that is required in the FHA program, what some of the requirements are. So for instance, and it could be something really simple. So, for instance, for FHA, you need smoke detectors for all the properties. You need CO2 detectors. You need your water heater brace. But in FHA, they may not like ripped carpet, or they may not like peeling paint. They really do hate peeling paint. So if we see peeling paint, we know we're going to need to ask for that if it's an FHA loan that we're getting. Or if it's like this HOP program, we know that there's maybe certain requirements on the property that the program's going to ask for. So we keep that in mind when we're out shopping. Like I said, normally we go out, we look at properties, see what's available, see what you can purchase, and then we start writing offers. So writing offers it's the same as it's always been. So we kind of come up with an idea of what we want to offer on the property. That hasn't changed because we do that on paper, and now we do everything, and we've always done everything digitally, so you sign everything digitally. But some of the things that you have to consider when we're writing the offers is the price. That's the first thing on the list is how much do you want to offer. So properties get priced 3 different ways. I don't have my little houses. I'm missing my houses. I know, I can't believe it. And I love my little houses. But I have
to figure out a way how to bring a community online.
I do. Okay, so I'm going to grab 3 pens, and I could do this with 3 pens. Boom, 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 boom. So I have a rocket pen, I have a Beautiful Homes pen, and then I have a green pen. Okay, so we got the blue rocket, we got the black pen, and we got the blue pen. Right? They're all really nice pens. Right? So and this is kind of the easiest way for me to explain pricing. So let's say that they were houses. Right? They all look about the same. They're all about the same size. Nothing, they're all about the same size. So if we go out looking in a neighborhood, I'll say, hey, for the neighborhood, on average, the properties are $500,000. Right? So normally your properties would be $500,000. So if we're writing offers on something, I know that 500,000 is a pretty good offer if it's an average house. So if we go out, we're looking at things, and we find a house that's priced for 450. Let's say we find a house that's priced for 450. We're going to get excited about that. But in that instance, it may be something where they price it low in order to get a lot of offers. So some agents will price properties low, and then we know that the property is going to go up in offers. So it may start at 450, but now we're offering like 460, 470, and I'll say, hey, the property is probably worth 500. I think that a good offer would be something around 480. And I'll give you that number, and I'll tell you kind of what I see in the area. Now, on the other side, let's say we see another property right down the street, same street, right down the street, the other property is going for 550. Now, in that case, I would say, this property is probably worth 500, but they've done a lot of upgrades. But even with the upgrades, even though it looks beautiful, I don't think the property is worth too much more than 520 or 530, even though it's listed for 550. Right? So in that case, we may decide, hey, we're going to write a lower offer. Now, normally you're not able to write a lower offer right out the gate. So if it's listed today, or if it just came on the market this week, we may not be able to do like a $50,000 price reduction, or even a $30,000 price reduction. Right? In those cases, it'd have to be something where it's And in those 17 days, you can do any inspections that you want. So you can go check the property, see the condition. We can have termite people come out. We can have an air conditioner person come out and check the air conditioning. Kind of all these things where people check on the property and see what's going on with the property. Right? And that way you know what's going on with the property. And during your inspection, you may decide, hey, I don't like this property because of whatever reason. Maybe you drive by at night and then you realize that the neighbors party too much. Right? And right now, nobody's partying, so you wouldn't know. But in a normal situation, you'd be able to drive through the neighborhood on the weekend and say, hey, these people party too much. And that may be a reason to buy. You may be a party person and say, no, I like parties on my neighborhood. I want the neighbors partying. So that would be a cool thing, or maybe it's something that you don't want, right? Another reason, it could be something as simple as you measure the bedrooms and your furniture doesn't fit, right? Because that could happen. Like you go to the property, you say, hey, I like this property, but I have a king-size bedroom set. And my bedroom set's not going to fit here, so I don't think I want to buy this property, right? So you get the 17 days to do all your inspections. The other thing you're able to do also is the appraisal. So that's where the lenders send somebody out to check on the property to make sure it's livable. And that's kind of what we were saying, depending on the different programs, there may be different appraisal requirements. So the bank's going to send somebody out and they're going to check two things. One, they're going to check that the property is livable, right, that you can live there. So even though you may say, you know what, I want a fixer-upper, and I can buy a fixer-upper, the lender may say, no, this one needs way too much work. So some of the stuff that lenders want is they want a working bathroom. It's okay if the second bathroom's not working, that one's maybe iffy, but they need at least one working bathroom. You also need a kitchen, right? So, because I've shown properties where the kitchen was gone. Like there was no cabinets, there was no sinks, there was no nothing. It was just gone. So in that case, the lender's going to say, you know what, this property is not livable, right? Like you can't just move into this property and not have a kitchen, right? Or not have a bathroom. You need doors. There's, a lot of things that you need in the property. So those are some of the things that you would get for your appraisal. So again, you have 17 days for your inspection, and then you have 17 days for your appraisal, and then you also have 21 days to do your to make sure you're going to get the loan. So we're going to be bugging Jennifer every single day, and she loves us bugging her. But it's going to be right. It's going to be up to her if she says yes, you can get the loan, right? So if maybe she starts your application and she kind of gets your numbers done, and then she says, hey, I was going through your loan application and I found something on your credit report that makes me nervous. So let me see if that works. Let me see if we can make that work. So you have 21 days to make sure that you can get your loan. So those would be reasons you can back out and get your deposit back. So that's once you're, all that goes into the offer. So once we open escrow, right, you're going to have that deposit that you're going to put down. You put everything in that you wanted in the purchase agreement, and we'll go over purchase agreements next week. But everything that goes, we'll go over detail by detail, but these are kind of the big things. So you'll take your deposit, and your deposit goes to an escrow company. Now, escrow company is a separate company that holds the money between you two. Because if you give the money to the seller, then at 17 days later, the seller's not going to give you the money back. Or if you give the money to the agents are just going to go to Vegas. Even if Vegas is not open, the agents are they're just going to go to Vegas. So that would be bad. So we give it to escrow, and then escrow holds it, and they're the ones that kind of put together all the paperwork with the lender. So on the lender side, we usually don't have, on the real estate side, we don't have that many things that go into the loan, right? So even though I'm saying, hey, it takes 30 days to buy a home, it's not going to be something that it's the realtor that takes a long time, because the inspection, it takes us like 2 or 3 days to order the inspection, and you get the inspection report the same day. The same with all the paperwork. So all the paperwork that's involved, and I just put away all my paperwork. So it's normally starts with as Isabel was saying, it normally starts with 10, 15 pages now, and it quickly grows to like 150 pages. Right? But even though it's 150 pages, we can get all those pretty much in just like a couple of days. So for the real estate side, it takes a week. Usually it takes the lender more time to get everything together because the lender has to verify your employment. And now some places are open, some places are closed. They have to verify things with the banks. Some banks are open, some banks are closed. So there's a lot of things that go into getting you that loan. So they're the ones that take a while to get you that loan. So that would be on your loan side. And then what else happens? So we go through, Jennifer tells us, yes, we can get you the loan. Yes, it does make sense. And then she's the one that would get you the loan documents. So Jennifer doesn't do it all by herself. I love making fun of her. But Jennifer has three, so there's three people that actually touch your loan. And she kind of mentioned it real quick that she's going to ask you for a lot of things. So Jennifer's going to ask you, she's going to start with, okay, we need your bank statement. We need your, we need to check your credit. We need to check where you work, find out, a little bit about where you're working. And then all of those things are going to go into a file. She starts a file, and she hands that file to the processor. Now, the processor is going to drive you crazy because the processor is going to ask you for everything. They're going to ask you for explanations about certain things. They're going to ask you for pictures of your kids. They're going to ask you for... They're gonna want to see that you're wearing a COVID mask. So you're gonna take like a little selfie with a COVID mask. You have to do all these weird things, and you're gonna say, okay, why am I doing all these things, right? But it's just part of the loan. The same with the HOP program. The HOP program is going to need you're going to need a lot of things for the HOP program, right? So whatever it is that they're asking for, because it's not just one loan that you're getting your home loan, plus you're getting the information for the HOP program. So those are some of the things that you have to understand. It's going to take a little while to get all that stuff for the processor. So the processor is going to get your huge file together. And that processor, you're going to think you're done, but you're not, because that whole file goes to your underwriter. Now, your underwriter grabs the file, and they're going to say, okay, this is way too much information. There's all these things. We don't need all this stuff, but there's going to be 2 or 3 more things that we need. So they're going to ask you for 2 or 3 more things, and then your loan is going to feel like you're done. You're going to be like, okay, we're done. It's finished. We're ready to go. The underwriter is going to send you over the loan docs to sign. And you're going to sign the loan docs. And everybody's going to be crying. Jennifer's crying. Isabel's crying. I'm crying. You're crying. Everybody's crying. We sign the loan docs, and that's not the day that you get the keys. So what has to happen is the loan docs have to go back to Jennifer. Now, Jennifer, do you guys fund like the next day? Yes. Okay. So
yes, next day funding.
Yeah. So once she gets the loan docs back, she can send the money to escrow so that they can give the money to the seller. So you don't get the keys that day either, because then escrow has to send the paperwork over to the county so that it gets recorded. And before we were able to walk into the county and do special recording the same day. With the whole COVID thing, now everything's closed. So we have to go back to doing everything digitally. So it's going to be one more day before it gets recorded and confirmed. So even if you sign loan docs on Thursday, let's say you sign loan docs on Thursday, Friday Jennifer does the funding, and then Monday is when we get confirmation. So you wouldn't get the keys until Monday. That's just something to keep in mind, because I know a lot of people get excited about moving, they're ready to go, but it's not something that you just go that quickly. It's something that takes a little while for you to get done. And then you get the keys. And
Yay.
I think that feels like the whole process, right? And did I miss something? No? Okay, and I know you guys got your mics on, so do you guys have any questions?
Oh, on the appraiser.
Yes.
Does the appraiser have to have that COVID entry authorization?
The appraiser, yes, I think so. I think everybody does. So it's even, it's not just the, so yeah, the buyer has to sign it, the seller signs it, the agent signs it, all the inspectors sign it. Also, because we just got new information on this, like just a couple of days ago. There's a whole, remember, I don't know if you guys have been seeing the news, but there's a whole CDC thing where the CDC says you have to do it this way and that way. So some of the information on the CDC recommendation to realtors, and then the California Association of Realtors recommended things to us. We can only show the property to like 2 people at a time. Mm-hmm. So I know before it was like everybody would bring their whole family to see the property, and there'd be like people on this side, people in the yard, people in the front yard. I tried running around with all these little groups, but now you can't bring your whole family to see the house. So you can't bring your parents, you can't bring your grandparents, you can't bring your uncles, you can't bring your kids. It's just 2 people at a time that are allowed inside the property. And as agents, we're supposed to wipe the whole property down. Like, we're supposed to disinfect the property before people show up and after they leave. So that's something that's pretty new right now that wasn't happening before. So so that would just be on the, what was the question? Something about showing? Oh, the other rules. Yeah, the appraisal. So and then on your appraisals, for a little while they were only doing drive-by appraisals where the appraiser didn't even go in the property. So that was really interesting because I shouldn't even say this, but I was excited because there were some properties that I knew if the appraiser went inside there would be issues. Where I say, oh no, if the appraiser comes in and sees this, he's going to flip out. So when they said, hey, the appraiser doesn't have to go inside, I was like, oh, then we don't even have to worry about some of these things. So that was kind of exciting. But no, they don't do that anymore. And then for the inspector, yes, the inspector has to sign the COVID form. So anyone that goes into the property has to sign the COVID form. And then the realtor has to make sure that the property gets disinfected correctly, because that's another one that has to happen. Yeah. So I know it wasn't happening before, but now it's a big deal.
Okay.
Mm-hmm. And what about your, Daniel, I didn't hear you say, what about your commission? How do you get paid?
Oh, yes. Okay, so let's go ahead and let's back up a little bit, because that's something that a lot of buyers ask. So, and they ask, like, what's the difference between, because I'm a real estate broker, and then there's brokers and there's realtors. So the big difference between a broker and a realtor is a realtor can get a license. You can get a license. You can say, hey, I want to get my real estate license. So you have to take 3 classes. You can do them online. And it's really nice now because you can do them online. But you can do them all online. It takes about a month to do each one. You take the test, you pass, and then you get your real estate license. So boom, you become a realtor. But you don't know what you're doing yet. So what you have to do is you have to go work for a broker. So a broker is somebody that runs an office. They manage the agents, and what they do is they're the ones that are there for anybody that has questions. So if my agent comes to me and says, hey, Dan, I have a question about this property. I have a question about this form. I have a question about whatever it is they have a question about, the broker has to be able to answer the questions. So a broker would be the one that runs the office, right? They're kind of the managers there. You have more tests that you have to take. You have a couple of years full-time experience that you have to have. So that would be the difference between a realtor and a broker. The good part for buyers is normally buyers don't pay for their realtor. So it doesn't come out of the buyer's pocket. So the way that the industry works is somebody that wants to sell their properties lists their property with an agent, right? And that agent usually works for the seller, trying to get the seller the highest price they can. So that's the job of the agent that works with the seller. That agent will split the commission with the agent that represents you as a buyer. So you as a buyer don't pay anything. It all comes out of the seller. The seller pays for both of the agents, right? So that's something to keep in mind, because the idea is the seller is going to get the money, so the seller is going to pay for the agents. The buyer, they have to pay for your loan. You have your loan costs, you have your down payments, you have your closing costs. You have to pay the moving truck, you need new furniture, you need all these things. So buyers don't pay a commission to the buyer's agent. Now, there are certain instances, like I know that sometimes when we're looking at auction properties, sometimes an auction property may have an auction fee. So that auction fee is going to be something where you have to pay the auction company a certain fee. So the auction company may charge you $10,000, or they may charge you $20,000, right? Depending on the price of the house. So that would be the only time where you come in and you have to pay something. But normally to your realtor, you don't pay anything to your realtor. So I think that was, yes, because that's usually what I start with at the beginning. Is there anything else that I missed? Nobody yet? No,
Yeah,
we're good?
cool.
All right.
Well, great. So we found a house.
We found a
We
house.
got the loan, and we're ready to move in. So next week we're going to talk about the contract because you need to understand what you're going to sign, and I'll be emailing you, Jose, the purchase agreement. It's a blank one that's not filled in, but it's good to know what you're going to be signing. Only because I had a client Monday who said that she was trying to sell her house, and the buyer took more than a month, and then canceled because she has a renter, and the renter didn't want to move out. And so they said that's how they can cancel the contract with getting their deposit back. But she says that's not true. So she wanted to know how she can get her deposit back. And I told her, do you have a copy of your purchase agreement? She says, no, my agent has it. So
yeah, that's all not good. But that actually reminds me, there's another form that's available. Right. So the other form that we're starting to use also is, it started kind of at the beginning of the whole pandemic, and the form is, hey, right, because it's almost like the apocalypse happened, right? It's like, hey, everything just stopped, everything, it was a natural disaster. So in a natural disaster, you're actually able to get your deposit back. Right? Because it isn't something where you were the one, it's your fault that this happened. Right? So in these cases, you can go to the, like technically the buyer can go to the seller and say, I can't continue with this because of this natural disaster. So I need my deposit back. And there's even a form that actually explains in detail what happens on each side. So the buyer and seller actually sign this addendum that says, because of the natural disaster, it may take me longer to get my financing. So for no other reason, maybe the bank closes or something. Or maybe, heaven forbid, knock on wood, my loan officer gets sick. And my loan officer now is in quarantine. So those kinds of things can happen. Or the escrow company that I'm using could get quarantined. Right? So because of that, in this form it says, hey, instead of closing in 30 days, I may need an extra 30 days. So that's a new form that came in, and I may have to cancel and get my deposit back because I got sick and I had to stay in the hospital for 2 weeks. Right? Wow. So that's something that, we're starting to see.
Wow. Okay. Great. All right. So, Jose, I'm going to leave it here, and we can start next Saturday to finish the session and give you the certificate. Do you have any questions or any concerns? Any concerns?
Well, yeah, I had a question. I think maybe Jennifer and you'll be able to respond to it. Does the HOP program only want first-time homeowners? Can I get an additional co-signer or not? Or is it just meant for the individual?
It doesn't. So you can get a co-signer, but remember, it's all based off of income, right? Mm-hmm. So I was actually looking at all of the guidelines. So let's say you do get a co-signer, but between the two of you, now you're making $85 5,000, let's just say, right, between the
Right.
two of you. If there's not that amount, if the amount of people in your household are less than, it might not qualify for that program. So you want to make sure your income qualifies. Joel, do you have the website for the HOP program?
Yeah, and it's you have 4 people in the home. It's under 80,000.
Mm-hmm. Yes.
And then,
Yes.
I'm not counting my wife's income because she just started working.
Okay.
So I can't. There's no way to go back on that. My dad's, you can. But this would be like the 3rd home he would purchase.
Yeah. So he
just finished paying off one. He's halfway done with another, and he was like, "Well, I'll help you co-sign for the home." But I'm like, I'd rather get this on my own.
Mm-hmm.
But if he has to,
then we wouldn't qualify because it is specifically for first-time home buyers.
Yeah.
So even though he's done paying off that home, he's still on the title, right? It's still his home.
Well, no, we put it into trust.
Oh, got it. Still, that's kind of a gray area. That's a very gray area because even though it's in the trust, he is probably the trustor and grantor for the trust.
Well,
trustor and trustee.
It's split between 4 of us.
Got it. But so you are on the trust as well?
Not until he dies.
Yeah, so he's not on the trust. And he's not on the loan.
No.
Okay.
Yeah.
Okay. So your dad, he's the trustor, correct? Right. So there's not 4 of you. He's the trustor and the trustee right now until he passes. So it's still in his name. Even though it's in the trust, he doesn't qualify for the first-time home buyer. But I did do a quick calculation for you while Daniel was going. So let's say you do get the HOP program and we're good. And I can get you WISH. And I can get you my grant. And you bring in $5,500. I said a whole spiel on it, Daniel.
Yeah, she said.
What? Oh.
She said.
Looking around a lot.
She said, "Wish program grant up to 22, hers up to 6, and that's it's unincorporated. It's 3,000."
Okay.
No, so LA County, all of LA County is 6,000. Outside of LA County, it's only 3,000. So I was doing that calculation with you bringing in 5,500. So HOP only requires you to bring in 1%, but in order to take advantage of WISH, you need to bring in 5,500, which is a little bit more than the 1%. You'd be looking at a loan amount of 386. So there's no MI because now we're putting more than 20% down. So with property taxes, insurance, and your P&I, you'd be looking at a payment of $2,376.
Yeah.
So here's going to be the easy way for you to know if you need a cosigner. You want to take that number, right? And again, I'm going just vague numbers, but this is going on the highest purchase price that HOP allows us, which is $495. And then all these other life down payment programs. So you're looking at $2,396. You want to add all of your monthly payments. So if Isabel's already pulled your credit, right? Because I know she does that for a lot of the clients. You want to add all of your monthly payments. So let's say you have another, I don't know, $500 in monthly payments. I'm just throwing numbers out there. You want to then divide that, Joe, by 45%. So whatever your monthly payments are, add this, you want to divide that, and then you want to times that times 12, and that's how much gross income you should have.
So you divide
could do it to 50 as well.
So you divide all the monthly payments. So you add all the monthly payments, divide them by 45%, and then when I get the sum of that, you would then multiply that by 12?
Correct.
Okay.
And that's what you want your monthly income, your gross annual income to be. Okay. Now, you can play with the figures of anywhere from 45% to, let's say, 48. I don't go to 49 or 50 because sometimes we don't calculate the income correctly like the underwriter does. That's why I always leave a little bit. So you can play with the figures you can divide that by 45 anywhere up to 48. Then you'll know what your income needs to be. Then you can compare that to the HOP So you'll be doing a lot of the back end work, but it's better for you to know these figures, and so you're prepared when you're ready to go.
And then for Daniel, I had a question.
Sure.
Have you seen the market go up or down in house prices?
Okay, so I'm glad that you asked that, because I get that question a lot. So I was feeling like the market was invincible, right? I was honestly saying, you know what, I feel like it's not going to slide, right? I kind of feel like, hey, because there are certain areas where people still need to work, right? People still need to live somewhere, so people are making payments. The problem that I did see very recently was, and the one that kind of made me say, wait a minute, I think there's going to be certain areas that are going to be more affected than others, is we were looking at a condo for a client. So I still have people that are buying, and there's a lot of areas that are not going to be affected at all. Right, so like a lot of the areas that you mentioned, those won't be affected so much, but there's other areas that will be affected. So, and there's certain areas that are going to go up a lot. So one of the areas that I think is going to go up a lot is all the stuff that's out around certain things that are getting built out. So for instance, one of the areas that we go out to a lot is Ontario and Ontario Ranch, right? All that new construction out there. That's going to continue to go up in price. The other area that's going to be going up in price is Eastvale, right? So Eastvale is going to go up in price because Amazon is building this huge shipping center out of there, and a lot of other people are building shipping centers out of there. So those are, they're going to be warehouses. So now there's going to be warehouse jobs. There's going to be union jobs out there. So people are going to move into that area. You remember the big stadium that got built? Right? I don't even remember who's going to play there. I think it was the Raiders in Inglewood, right?
Okay, well, yeah, I was actually a part of that.
Yeah,
so the developer, but we had to hire 10% minorities. That was through South Bay Workforce Investment Board, through the county, Mark Quigley Thomas. So I was a part of that whole measure to make sure we had minorities in there. But the areas that weren't subject to, what do you call it, eminent domain, they were being priced out, so they were being sold to athletes already. So a couple of those, and they're horrible little homes, and they're going for like $800,000.
And you remember that nobody wanted to be in that area before the stadium. So certain things
it's the hood. It's prostitutes on Century Boulevard and Sepulveda.
It was a little scary, yeah. But now, now that area is going to explode. So so certain areas are going up in price. Right, so that's going to continue to happen. All the stuff along the coast, I mean, we still have Apple building out, Google is building out, Facebook is opening offices all over the place. So those kinds of things, those are the ones where the prices are going to go up. And then some of the areas where prices may go down is going to be like Riverside, San Bernardino, like your Lancaster, your Apple Valley, stuff that's way out there. Some of those areas may go a little soft. The one that I had mentioned was the condos. So condos usually move more with pricing, right? So condos are a little more, they get affected a little bit more. When prices go down, condos go down faster. When prices go up, condos go up faster, right? So they move a lot more. So I saw this one complex, and this definitely affects your loan, and that's why it affects your price, where 20% of the people were behind, or more than 20% of the people were behind on their payments. Now, Jennifer knows that if people fall behind on their payments, Jennifer can't do the loan anymore. So if there's too much delinquency for the HOA fees, like if the community is not collecting enough money to pay for its bills, Jennifer's going to look at that paperwork and say, you know what, this condo complex is in trouble. So in something like that, in that case, I think you are going to see it's just that complex go down a little bit. So there are going to be certain areas that are going to be better deals than other, and it's going to be like a situation by situation basis. So maybe that particular condo complex will take, because they're not that much, so that complex may take like a $30,000-$40,000 price hit for that complex. But the complex across the street that's in good condition, that one may not take any hit at all. So, it's going to be on a case-by-case basis. Also, I think a lot of people are going to start to let go of properties that are just in horrible condition. So that you're going to see. I think you're also going to see people that are just behind on their payments because people are not working right now, and it's not going to be the same. So it's not going to be the same as what it was during that mortgage crisis. Because you remember the mortgage crisis, that was really bad. The market crashed. So that we're not going to see that again just because the mortgage industry knows what's going on. Like they kind of learned what happened last time. Right?
100%. And I can, and sorry, Daniel, to interrupt. So I can just speak on that. They that's why they've changed a lot of the guidelines, like the credit score of 620 going to 680. They've changed a lot of cashing out. You cannot cash out on a second home or a rental property right now. You cannot do a refinance cash out. There's little things that the bank is doing, the financial industry is doing to protect themselves so they don't fall into that same situation from 2007, 2008. I'm going to agree with Daniel though. Right now you do see, you started to see that first 30-day late on some properties. So you might see a little bit of a decrease, but I don't think it's going to be where we were in 07 or...
No, because that was a mess. So now the banks kind of know, hey, this is how we're going to handle it. This is how we're going to do modifications. This is, how we're going to work with people that are in trouble. So I think the banks are going to be a little bit more flexible so they won't foreclose on everybody, but you're still going to see a lot of people that say, hey, you know what, I want to sell my property because I'm out of work. I know I have $100,000 in equity, so I'm going to sell it. So you're going to see a lot more people list properties, and you may find a deal on something where maybe the property needs some work. So even though they're selling it, it may be something where they can't do the work, so they let it go for a lower price. Or they're falling behind on the payment, so they want to sell it and just get rid of it. So it's going to be kind of case by case. It's not going to be across the board that everything's going to be horrible. But you're going to see, like I said, you're going to see people that are going to start to sell properties. So some properties are going to be deals, some are not. It's going to depend. All right. Was there another question?
No, that was it for me.
Okay. So let's see.
You're muted, Isabel. You're muted.
Yeah, Isabel's off.
Did you read my lips?
Yes.
We were trying to.
We'll see you next week, Jose, okay? And we'll finish this up. And thank you very much, Daniel.
Right. Thank you, everyone, for participating. We'll see you next week.
Thank you, Rich. Jose, you have our information, so yeah, you can always call us and get a hold of us later.
All right, sounds great. I appreciate it.
You're going to bring lunch, right, Jennifer?
I have lunch.
I had donuts this morning.
All right, bye.
Bye, guys.
So what?
Oops.